So the big beautiful bill has passed, which the market was anticipating more or less. I think that's probably what's been helping equities move higher the way they have been. But I do want to cover just what you think about the way bonds, gold, and Bitcoin are going to go from here, because this big beautiful bill is a massive spending bill, and a lot of people are saying this is what pushes Bitcoin higher. This is what crushes the dollar. So I'm curious to hear what your thoughts are on that.
Well, let's first address the Bitcoin maxis because, and they're not wrong to say this, but generally every time there's a fiscal bill on the table, they're Bitcoin euphoric with the Inflation Reduction Act. Same type of reaction. Bitcoin's gonna go nuclear, and sure enough, I mean, Bitcoin has gone up over time, so it's not wrong. It's just you have to keep your expectations under wraps here, right? Like that's the biggest thing, especially in crypto. Everyone's got these grand ideas of Bitcoin going to 150, $200,000 just like quickly, but just understand it's now a $2 trillion asset. So not saying it can't go higher, but in you have to have some sort of reason as to the level and rate of appreciation after a certain threshold. It's going to take essentially $2 trillion. You're going to have to increase the market cap by $2 trillion from here, right? So you have to keep that in. It's easy to go from 500 billion to a trillion. It's 100%, right? It's only up 500 billion. Now for it to go up 100% from here, it's got to go up 4 times basically what it took, right? So it's going to take, this is the law of large numbers. It's going to take some time, but I don't think Bitcoin's topping or anything like that. Just keep your expectations in reality there. Now, back to the big, beautiful bill. I don't want to get too political, but I do think that there are some negative consequences that come with this bill in terms of the bond market. That's probably the thing about the big, beautiful bill, and we'll just talk about it from a monetary, from a spending perspective or a debt perspective, is it got worse as it went through the chain of command. From the time it left the House, went to the Senate, and came back, it was a worse in terms of fiscal health. It was worse, right? So it just got worse as it went around the block. And I think that generally the thing that the market is going to be concerned about here is the future interest rate path and the ability for the central banks to hold their independence. Because at the end of the day, if you can have an independent central bank where they're able to set policy rates properly, this is not going to be as big of an issue as everyone's making it out to be. But if you have a scenario where the political influence really erodes, influence from Washington erodes the Fed, you're going to have a problem where they're going to bring rates down too low, right, to levels that would be considered stimulatory in an environment that's already overstimulated. And I think that's the big fight right now, right? That's what's going on. So the big beautiful bill is only a road or a goalpost on the highway type, or you call a mile marker on the highway, right? Like we're just passing another very large fiscal bill, which we've seen them before. This may be more interesting than others, given that it is in an administration that's so anti-Fed. So this is going to be very different, I think, in how we see the progress from here in terms of who the president puts into shadow chair power by the end of the year, right? And therefore tries to undermine forward guidance at the Fed. That's going to probably happen and come next. So we're going to have to be ready and watch that go down. So that's going to be something, that's going to probably influence the interest rate and bond market as well. And all these things come down to the one fact that, the deficit is pretty stimulatory. Now, we keep having this conversation week after week, and I think it's going to be a conversation we're going to have for a very long time. You and I is going to be,
Yeah,
can we actually get
that's
a
pretty much
recession?
where everything comes down to at the moment is the deficit.
Yeah,
And
yeah, and can we get a recession at 6%? Is it
yeah,
possible?
well, is the Fed independence, is that really something you see as possibly being lost?
No, I don't think that the Fed's actually. So, like, look, Congress can come out and they can just undo the Fed from an amendment, right? They can amend, or call it de-amend the Fed, however you want to put it, but they're not going to do that. At least not right now. And I don't think that you have imminent risk of the Federal Reserve being disbanded, ended, or like seized in terms of control. I think what the highest probable outcome scenario here is going to be some sort of shadow bank chair act, because Trump's not going to straight up remove Powell, given the barrier, the legality barrier to do it, to take Powell out of his chair, out of the chair position. But what he can do is, since Powell's term's up in May, he can quite easily, all he has to do is name his next pick and put that guy on TV and let that guy start talking. People are going to pay attention, right? Because Powell now basically has a stopwatch on his position, on his authority.
Yeah, but he's gonna have to influence the entire Federal Reserve Board. It's a vote for a policy.
Oh, yeah, it is. This is true. But at the end of the day, the market will almost take it as the ability for the chair to coerce the board, right? Because the chair can coerce the board to some degree. Now, there's going to be dissents, and there's going to be people that don't agree with. It's kind of rare, but it does happen. There does have to be a vote to move policy, right? There's going to be a vote, but the market's gonna, if you put a super dove in there, right? If you put like a super dove, the market's gonna take notice. It's not gonna. There's not gonna be a 0% chance of nothing being priced in, right? Like, the market's gonna start thinking things could possibly happen, and I think that that's probably the angle that happens first, or the one with the highest probability at the moment, where Trump can nominate someone by December, and then you have, if it's in December at that point, it could be earlier. But if it's in December, you have 5 months of basically shadow chair dove posting and dove media headlines of, what, again, grand gestures go a long way when you have public when you control the narrative, right? Like, if you're the Fed chair, or you're the soon to be Fed chair, and you're out here saying that the Fed's going to cut interest rates by 50%, right? You're going to cut the rate in half, right? Maybe you can only get 4 or 5 cuts out of it, or 4 cuts out of it. You can't get 8, right? But like, you're already going to weaken the curve, even though, like, he's not in power, right? And even though the Fed has to vote, there's this idea, there's this general idea that, this guy's a super dove. Maybe he's just like, what happens if he's half right? You know what I'm saying? Like, it's a game. It's all an illusion. That's how this works. Because at the end of the day, we're just pricing in, we're just manipulating the market without any actual authority. And that's what's going to happen here. I think that's Trump's goal. I think, because he knows he's aware he can't really remove Powell directly, so he's going to try and do that.
Yeah. And he's really kind of trying to put Powell into a tough position where so far Powell has just been ignoring him and not commenting on anything he says. But what happens if more and more politicians start getting pissed off that the rates are so high, and he gets more pressure from other politicians as well on top of Trump?
Yeah.
Then
Yeah.
he's going to be in a position where he's going to have to start addressing it.
Yeah. Now, obviously, none of these political opinions manipulate our positions or our positioning outlook, right? Like, that's all that's all independent to this. This is kind of just like an idea of what's going to happen next. Our positions are systematically configured, so it doesn't really matter what we think on politics. But in terms of what I expect, I think, yeah, Powell is in a position here where he's gonna, the man is taking relentless PR, like, whiplash on a daily basis from the president. Like, and this is not uncommon. It's happened in the past. And I think it's just where we are in terms of where we've been in history. It's very easy to get messages out there. You can put out a post on the internet, and hundreds of millions of people have it in their pocket instantly. It's not in the newspaper. It's not on the TV at night. It's literally just push notifications to everybody all at once. And this type of direct, you can call it a style of, like, direct notification, direct marketing, whatever you want, from in politics. You can basically PR blast someone in minutes, where it would have taken weeks to get that message across, 50 years ago. And I think that the situation that we're in here is that Powell is taking an immense amount of heat, and he's held it together pretty well. And we can always, is the president right? Is Powell right? I think at the end of the day, the jobs numbers, they keep coming in fine, right? The economy, the unemployment rate is falling. There's some immigration persuasion in there, right? In terms of like lowering the or call it uh, deportations and tightening up the labor supply. It's affecting this, but I think that ultimately the situation here is that you're looking at a Fed chair that's going to be out soon, and one that has some sort of honor in the idea of independence at the Fed. Despite what you may think of him, he's very monotone when it comes to talking about this situation. He's not, Powell's pretty straightforward when he doesn't want to bring up forward guidance. He doesn't want to come in on fiscal policy. And I think that, quite frankly, it's the fiscal policy that's the problem here, right? We have a government coming into power here that's passing a stimulus bill with a 6% deficit, where their idea is just add more, jet fuel to the fire and let's burn, aka run it hot and burn our way out of this with growth. And that's, the Fed is not going to be like, oh yeah, we'll just cut rates in half and let just let it go like that. They're going to look at it like, well, if we're already running, employment's essentially at a maximum, unemployment rate's at 4.1%. We're putting, plus 50 to plus 100K at least plus 100K payrolls every month on the table. Like, what are we going to cut rates in half for?
Yeah.
You know,
And at the end of the day, like growth keeps climbing, even from a system perspective. Growth has been climbing, and it's looking like risk on is going to come. Like equities higher from this stimulus, from this fiscal stimulus. It doesn't even need to come from the Fed at the moment. The Fed can remain here, and growth has been staying strong and seems to be continuing to stay strong. Like once the system pivots, that's our go ahead to say that this is going to be a somewhat long lasting trend.
yeah. And look, I think when I was saying earlier about the Fed or I don't want to say the Fed, but the independence of the Fed being lost, this is not something that happens overnight. At least it's happened in third world countries very quickly, but this is a progressive thing, especially in the United States, where I think this is going to be a long game. And what's going to happen? It's pretty simple, right? Right now, you have interest being a top three deficit, a top three issue on the deficit, right? Like out of the top three spending categories, this is a top three spending category, and interest expenses. And I think that the fact that interest expenses are a top three spending category, and it's making up 50% of the deficit. So hypothetically, if you were to take, right now we're running a 6% deficit. People consider this recessionary level stimulus, right? And we thought that we had the possibility earlier this year and even last year of hopes that the deficit would actually continue to tighten upwards and go more towards zero, more towards a pre-pandemic path, and that has not happened. And I think that the issue here is that when you're running a 6% deficit and 50% of that deficit value is interest expenses, meaning if I were to take the interest expense on the annual fiscal spend and I were to remove it, you would actually have a 3% deficit, which is what most people would consider historically average and not too inflationary, not too stimulatory, just baseline, 2 to 3% deficit, right? When you look at it like that and you say, well, we can get to a 3% deficit overnight if we just don't pay, if we have zero interest expenses. And there's two ways to get zero interest rate expenses. The Fed basically cuts to zero, or you default on your debt. And the issue here, I think we're going to run into, if the spending pace keeps up, this fiscal path keeps up, is everyone's going to at some point turn around and stop arguing with each other about, like, maybe the left wants more more spent on healthcare. Maybe the right wants more spent on defense. And instead of battling over, oh, we have this, X portion of our deficits already taken up by interest, at some point everyone's going to turn around and say, we could both get what we want if we just fix the interest problem. And there's only two ways to do that. And I think that if this continues, what's going to happen is you're going to eventually have both parties turn against the Fed instead of it being a one side versus the other side, right? Um, and I think that you're going to start to see that happen the longer interest on the interest on our debt, or I should say interest expenses, right, stays in the top three of the expense category on fiscal. I think that's going to just take up mind share. And that doesn't mean we default. That doesn't mean it's a crisis. It just means that the Fed is going to get more politicized, even though they are somewhat independent. Like, Trump's not going to be, if this continues, Trump is going to be the last one to ream Powell out. It's going to continue.
Yeah.
And it won't be Powell. It'll be somebody else. It'll be a new Fed chair. Maybe, there's also a whole other problem we're running into here with this, with Trump's appointment to the next Fed chair is how much over promising is he going to do versus under delivering? Because anyone who takes the spot to be a super dove, right, is going to set extremely bad precedents for the Federal Reserve as a whole, and they will tarnish their name. So like their in personal track record will take a hit. So you're risking your reputation on this. So someone, a really smart individual, probably plays the cards and say, yeah, I'm going to be a super dove, walks in there and says, yeah, actually we can't really do all this. Right? Like that's like the 40 chess move, but I don't know if we're going to see that. Depending on who he appoints. Apparently today we're hearing some news that Scott Bessent could possibly be in the running for Fed chair, which would be insane.
Yeah.
So there's a lot of moving parts here, but in terms of the market, how this all comes back to the market, because that's what all this is for. Persistent attacks on the Federal Reserve will probably lead to higher rates. If the Fed cut rates right now the way Trump wanted, I assume the long end goes for it. I assume. I mean, if the Fed dropped rates 200 basis points this month in July, mortgages would be 10%. Long end would be 6-7%, right? Like it would
Just long-term inflation expectations would just rise
because
considerably.
again, I look at it like this. Like, let's look at the annual PCE. I think I did this last week, but pretty simple. This is core PCE. I don't really want. Sorry. Let's look at headline. So here's annual PCE. A good way to look at this is where we were in 2018. So in 2018 we peaked at 2.3%, right? And CPI very similar, right? Like, so just remember this chart. We peak at 2.3, we go downwards, and then we go down before we hit COVID. Here we're just chugging along around 2.3, 2 to 2.3%. We're just chugging along, right? So we haven't really settled on PC below the 2018 highs. And then if we go to inflation, right, it's a little bit better. We are below the 2018 highs, but we're still not below 2%. And we're still not below, the historic target of where the Fed wants rates to be on inflation or on CPI or PCE. So the question you have to ask yourself is: the Fed's been at 4.34% plus 4+% for 2 years now. Why has an inflation at this point fallen to 2%, below 2%? If the Fed was overly restrictive, which they were originally, then obviously they reduced their rates quite a bit over the last year. They did some rate cuts, but they essentially are in a state where they're moderately restrictive. They're not overly restrictive anymore. They're just moderately restrictive. You could even claim that they're more neutral at this point. The Fed's basically a balance. So if they're in balance here and inflation can't fall below 2%, what do you think is going to happen if they cut rates in half? Do you think inflation is just going to magically just start printing below 2%?
Yeah, no, not at all,
If
especially with this new spending bill. Like you're
Of course,
basically
yeah.
coming out with larger deficits, which could possibly even push the neutral rate higher.
There you go. And then you're stuck in this position where the Fed's going to have to either re-hike or just let inflation run, which I don't think that they're going to do that. I mean, you're talking about like that. Now you're talking about a severe scare on dollar viability right there if they let that happen, which I don't think they would. But
Yeah. Well, I think the odds of a spike in inflation that fast and of that magnitude just can't happen at 4% rates.
that's my point. That's why I'm saying like the Fed is in a position where, I think that I think that they've already through forward guidance brought the terminal down 100 basis points from where they are right now to 3% over the next like year and a half, right? So over the next like 12 to 18 months, they've already priced in via forward guidance, dot plots, whatever, and commentary. They priced in 100 basis points of cuts. So, um, if we take a look at the EFR, they're essentially down to their cycle low is still higher than the 2019 peak on rates. So their cycle low is still higher than that. And that's just because of neutral rates. Neutral rates, again, due to the fiscal gap, right? The economy is not constrained right now. We don't have significant areas of weakness in the economy, and we're running deficits that you would use to carry an economy out of a recession. So therefore, the Fed's at a point where they don't have to panic. And Powell has no real way of not politically saying of keeping politics out of the statement with saying like we don't have to do anything because you're doing everything on fiscal. So we can just stay here. If the big beautiful bill cut the deficit down by 50%, Powell would probably cut 50 basis points this month at a minimum. But that's not what's happening, right? So
Yeah.
we have to play the game here, or at least the Fed's going to play the game. The way Trump looks at it is actually you could tell based off of his statements, it's very, very simple. He just wants rates back to where they were when he was the president the first time. That's it. No meaning, the deficit doesn't come to mind. Nothing comes to mind. It's just last time I was president, rates were 2%. Let's bring them back to 2.
Yeah,
Because
he's just missing so much with that, though.
But you see how he's looking at it. He's looking at it like, look, last time I was president, the economy was booming, great economy, everyone loved it, markets up. Rates were at 2% for that to happen. So let's bring rates back down to 2% so we could have that happen. And then he also looks at it like this. Well, like I was saying earlier, the deficit. You cut rates in half. If you can reduce the finance costs, even by 25%, you're bringing the deficit from 6 to 4. You're cutting the deficit by just moving interest. So they're looking at it like it's a way to kind of manipulate the deficit without actually having to cut spending. I should say discretionary spending, right? Because interest is mandatory, so they don't have to manipulate mandatory spend. They don't have to manipulate their discretionary spending. They can just have the mandatory interest expenses drop, and therefore they can kind of level the playing field and keep the spending the same. So that's where we are. And I think that when you look at the NASDAQ and what's going on here, like the market's obviously picking up on the stimulus bill. Risk assets, they're up. We went from tariff headlines, tariff worries, deficit value. This was all basically headline fear mongering all the way down. Growth took a small hit due to inventories, and we've rebounded quite well. And I think we're on the verge of actually flipping risk on in the near future here. We were speaking about this last week, but I do think that's coming up very close.
Yeah. Like, do you foresee anything bearish happening? It really seems like we've kind of passed any possible bearish news at the moment.
I think you're going to see equity market dips. This is what's going to come out of this. Maybe if it's not next week, maybe it's anything can trigger it. Maybe it's Trump. At the end of the day, Trump also burned a lot of political. I should rephrase this. Trump also has regained a lot of playing ground here, right? The market's at all-time highs. His big beautiful bills passed. Midterms aren't until next year. He can play around with the market now. Not that he's going to send the market back down to the lows, but he didn't. The market was too low in April. I think that he had to walk a lot of things back because people were really getting scared, and data was really starting to show things, especially growth, that things were not good. Even consumer spending took a hit and stuff like that, and it all rebounded pretty quickly at this point. But that's because a lot of the things were walked back, and I think that we're at a point now where we kind of have our system has been slow down, risk off, and we're pretty much at the point where, if we take a look at our system, we're deadlocked. You want to talk about 0-0? We're in the middle here. We're days. Look at this. Growth index is over Momo. We are days away from going risk on, and we saw some good action in some of our holdings. today, but that we could see some continuation there. But ideally, the pop that we're going to see, we want risk on. We want to be in risk on. So ideally, what happens is our current holdings rotate higher. They continue their rotation higher. They provide us a nice exit and rotational opportunity out of them and into risk on assets. Thank you guys so much for listening. I hope you have a great holiday weekend. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.